Swing trading. Hold for days, not minutes. About an hour a day. Is it right for you?
Swing trading is what you do when you want exposure to a real price move, but you don't want to stare at a screen all day. The hold is 2 to 14 days, the chart is daily, the time commitment is around an hour a day, mostly after the market closes, and the realistic win rate, with a properly defined edge, sits between 35 and 50% at 2 to 3 times your risk per trade. That's the entire job description. Everything else, the indicators, the patterns, the YouTube setups, is a tactic chosen to deliver that core idea. And there's one habit that kills more swing accounts than any bad chart pattern ever has. Hold that one. We'll get there. Here's where swing trading actually sits on the time frame ladder. Scalpers hold seconds. Day traders hold minutes to hours and close everything before the bell. Swing traders hold 2 to 14 days. Position traders hold months. The thing most beginners miss? Those aren't preferences. They're entirely different jobs. A day trader needs 4 to 6 hours of screen time, fast execution, and level 2 data. A swing trader needs a daily chart, a few alerts, and the discipline to sit out slow days. Mix the two and you build a flat equity curve faster than you'll learn either one. Pick one, pick swing, and the whole stack changes underneath you. Charts, broker, cost structure, tax treatment, all of it. A clean swing trade has 5 named parts. The setup, the chart configuration that catches your interest. A 20 EMA pullback in a stock making 52-week highs on rising volume, for example. The entry, the exact price and the exact trigger that puts you in. A buy stop at yesterday's high after a bullish hammer at the EMA. The stop loss, the price at which the thesis is wrong, full stop. Position size, calculated so the distance from entry to stop equals 1% of your account, or whatever number you've chosen. And the exit, a measured move target, a trailing stop, or a time-based exit at day 10. Here's the part most setups skip. All 5 fields get written down before the trade, not after, not during, before. Because the discipline isn't the indicators, every swing trader uses roughly the same 3. The discipline is forcing yourself to define those 5 fields every single time. Once they're written, your only job is to follow the plan or close the trade. Adjusting the plan after the position moves against you, that's the failure mode. That's the whole game. Now the only number that actually matters, position sizing. Risk a fixed percentage of your account per trade, typically 0.5% to 2% depending on conviction. Measure the distance from entry to stop. Divide the dollar risk by that distance. That's your size. $20,000 account, 1% risk, that's $200 on the line. A $2 entry to stop distance gives you 100 shares. Not 150 because you feel good about it, not 50 because you're nervous, 100. The size is whatever lets the stop be a 1% account loss. Here's the part that catches people. You do not move the stop to fit the size you want. You let the stop define the size. Because the only reason swing trading survives losing streaks is that no single trade can hurt the account. The math protects you only if you respect it. One warning though, overnight gap risk. On an earnings night or a major macro event, your position can open 10, 20, even 30% through your stop. Your stop is a planned loss, not a guaranteed one. The defense is either being flat before the event or sizing for the worst plausible gap, not the planned stop.
Capital and broker. This is where swing trading gets quietly beautiful. The pattern day trader rule, the one that locks US traders under $25,000 out of day trading, doesn't apply to overnight holds. None of it. So a $1,000 account can swing trade US stocks today. A margin account isn't required. Cash works fine. What does matter is asset class fit. Stocks at Schwab or Fidelity. Forex at Pepperstone or IC Markets. Multi-asset at Interactive Brokers or Saxo. And here's a counterintuitive one. You do not need the cheapest spreads. A day trader doing 200 trades a week cares about the difference between a 0.3 pip and a 1 pip raw spread on Euro USD. That's their entire margin. A swing trader doing 5 to 10 trades a week? Rounding error. What does matter for Forex and CFD swing traders is overnight swap. Some brokers' swap rates make holding a position for 10 days more expensive than the trade is worth. Check the swap table before you assume a strategy works on a pair. That's the real cost. Tools follow the same logic. You need daily and weekly charts, drawing tools for support and resistance, volume, a handful of indicators, 20 EMA, 50 SMA, RSI is plenty, alerts on price levels, and a journal. That's it. You do not need order flow. You do not need level 2. You do not need news algorithms or millisecond execution. Those are day trading tools, and buying them for a swing strategy is paying for speed you will never use. Set the alerts, walk away. Look at the chart again after the close. That's the entire workflow.
One real money note before the behavior piece: tax. In the US, swing trades held under a year are short-term capital gains, taxed as ordinary income. Most swing trades close in weeks, so long-term rates rarely apply, and the IRS trader tax status election is generally off the table. The frequency bar is set by day trader volume. In the UK, capital gains tax kicks in above the annual allowance, with rates depending on your income band. Spread betting profits stay CGT exempt for retail. Germany taxes capital gains at 25% under Abgeltungssteuer, plus the solidarity surcharge. Australia may treat frequent traders as carrying on a business, taxed on revenue, not capital. Confirm with a local accountant before you assume. And now the habit I told you to hold on to at the start, the one that kills more swing accounts than any bad chart pattern. Here it is: moving the stop. Once that stop is set, it defines your thesis. Lowering it because the trade went against you isn't strategy. That's hope wearing a strategy costume. And it sits next to 4 other behavioral failures that show up on every blown account. Averaging down without a sizing plan written in advance, because the loser hurts. Cutting winners at 1R when the target was 2.5. That single habit cuts expectancy by a third. Overtrading, forcing setups on slow days because doing nothing feels wrong, and holding through earnings. Earnings night is a coin flip with extra leverage. Exit before or size for the worst case gap. Notice what every one of those has in common. They're not chart problems. They're plan versus emotion problems. The technical edge in swing trading is small. The behavioral edge is the whole thing. So, does this actually fit you? Short self-test. Do you have 30 to 90 minutes a day, mostly outside market hours? Good fit. Can you watch a position go 3% against you for 2 days without panicking? Good fit. Can you skip days where no setup appears? Good fit. Do you need constant action? The dopamine of intraday markets? Day trading, probably. Are you under $25,000 and want US stock exposure? The PDT rule picks for you. Swing is the only option. Here's the verdict. Swing trading is the trading style built to fit a real life, a job, a family, the rest of your time. But it only works if you treat the plan as the strategy. The indicators don't matter much. The patterns barely matter. What matters is writing the 5 fields down before the trade, sizing so a single loser cannot hurt you, and never, ever moving the stop once it's set. Do that and you've got an actual edge. Skip it and the chart never saves you.
Write the 5 fields down and never move the stop. Full breakdown linked in the description.